Welcome back to The Explainer. We've got a fantastic one for you today. We are unpacking the H1 2026 report on Banco Santander, and let me tell you, it's a completely fascinating set of data. If you follow global finance, you already know this is a massive name, but the numbers in this latest analysis, they reveal a story of transformation that is just incredibly compelling. So get comfortable and let's jump right in.
Okay, let's dive into this. When you hear the name Santander, what comes to mind? Probably a traditional local Spanish bank, right? Well, the source material we're looking at today shatters that misconception entirely. We aren't just looking at a regional lender anymore. We're asking a much bigger question based on their recent financials. Is this institution quietly transforming into a global shareholder return machine? The data suggests a massive shift in scale and strategy, and it's absolutely crucial we understand exactly how they're pulling this off.
To make sense of all the data from the 2026 report, here is our roadmap for today. 1. A global banking machine. 2. Explosive customer growth. 3. The acquisition strategy. 4. Rewarding the shareholders. 5. Navigating the risks. And finally, 6. The final verdict.
Section 1. A global banking machine beyond Spain's borders. The source makes it explicitly clear that Santander is now a sprawling multinational financial group. They've got major, deeply embedded operations across the UK, the US, Brazil, Mexico, Poland, and throughout Latin America. And what's really interesting here is the sheer velocity of these numbers. First half revenue hit 30.847 billion euros. That's a solid 6% year-over-year increase. But look a line down. Underlying profits surged 15%, 7.328 billion euros, and underlying earnings per share jumped an impressive 20%. The report highlights a vital detail about this. More than 95% of this group revenue remains directly linked to customer activity. So what does that mean for us? It means these earnings are highly resilient even as global interest rates bounce around.
Section 2. Explosive customer growth, fueling the engine.
12 million. Just take a second to let the scale of that number sink in. According to the report, Santander added 12 million customers year over year. This isn't just some vanity metric. It is a highly aggressive catalyst for their entire balance sheet. Because of this massive influx of people, the bank saw its loans jump by 9% and customer funds increase by 11% in constant euros. It's just a phenomenal explosion of raw volume.
Because look, a bank doesn't just want you to open an account and walk away, right? They want to activate the flywheel effect. It starts with a basic account, then they cross-sell a credit card. Maybe a mortgage a few years down the line, followed by insurance and investment products. By moving a customer sequentially through these exact steps, Santander dramatically increases the lifetime value of every single one of those 12 million new customers. It's a highly calculated global platform strategy.
And they aren't just growing blindly, they're optimizing. The source details Santander's One Transformation program. The result of this, total costs actually fell by 2% in constant euros if we exclude acquisitions, and the efficiency ratio improved to 42.8%. Now in banking, a lower efficiency ratio means less cost is required to generate revenue, so they are effectively doing way more with less.
Section 3. The acquisition strategy, buying growth.
It's been a seriously busy year for Santander. Back in February 2026, they announced a massive $12.2 billion deal to acquire Webster Financial in the US. Then, just a couple of months later, on April 30th, they wrapped up their acquisition of TSB in the United Kingdom. The report notes that these deals bring immediate, massive scale, mountains of new deposits, and crucial exposure to incredibly lucrative US commercial banking and wealth management.
So the crucial point here is understanding the trade-off. You've got clean, highly predictable, organic growth on one side, and you have to weigh that against acquisition-driven growth on the other. Buying growth is undeniably powerful, for sure, but it comes with dangerous execution risks. The source impartially notes that to justify these moves, Santander absolutely must successfully merge different technologies, employee cultures, branches, and really complex balance sheets. The synergies have to outweigh the massive integration costs, or else shareholder value just gets destroyed.
Section 4. Rewarding the shareholders, the return engine.
For the income investors tuning in, the data here is an absolute beauty. We're looking at a clear up and to the right trajectory. The cash dividend paid against the 2025 results was 0.240 euros per share. That represents a very healthy 14% growth compared to the previous year. The source highlights this as a major positive signal from management regarding the bank's underlying real-world cash generation capabilities. And looking forward, the policy is getting even more generous. The report details that from the 2027 results onward, Santander intends to distribute approximately 50% of its total profit right back to shareholders. That massive pie is going to be split with around 35% flowing out as cash dividends and roughly 15% dedicated to share buybacks.
Now we have to talk about those buybacks, because the sheer size of this program is staggering. The bank currently has a €5.0 billion active share buyback program going, and they are targeting at least €10 billion in total buybacks across the 2025 and 2026 results. The mechanics here are simple but powerful. Fewer shares outstanding ultimately drives up both the per-share value and the EPS for everyone still holding the stock.
Section 5. Navigating the risks, the brakes on the engine.
Let's start with this standalone number, 14.0%. In the banking sector, this is arguably one of the single most important figures for an institution's very survival. It is the ultimate metric of financial defense.
That 14.0% is Santander's CET1 ratio. In plain English, this is their financial armor. It's the vital core capital buffer that provides protection if the economy suddenly turns, credit losses spike, or an unexpected shock hits the global system. A strong 14.0% ratio means Santander currently has thick armor, which is absolutely essential given their aggressive expansion strategy.
But, armor can be dented. The source provides a very clear checklist of dangers, the bear case triggers. If the global economy weakens, businesses and consumers struggle, and bad loans skyrocket, that leads to surging credit losses, which can destroy profits in a heartbeat. Other major threats include that crucial CET1 ratio falling materially, a collapse in net interest income, accelerating operational costs, or just failing to properly integrate those massive TSB and Webster acquisitions we talked about earlier.
Section 6. The final verdict, objectively scoring Santander.
And his final scorecard brilliantly illustrates the balance the analyst struck. Metrics like profit growth, customer additions, capital strength, and buybacks all score a flawless 5 stars. However, they've objectively downgraded acquisition risk and credit risk to 3 stars, and flagged OTC trading liquidity as a high risk. When they put the whole shebang into the mix, the source awards Santander an overall rating of 9.0 out of 10. They see it as a highly potent mix of massive growth weighed against medium to high macroeconomic risks.
Based on that 9.0 rating, the source lays out this specific, impartial action plan for investors. They suggest a buy-on pullback if the valuation drops enough to offer a margin of safety. They rate it a hold as long as the current trajectory of profit and capital generation keeps improving. They advise to closely watch how the TSB and Webster integrations go, along with global interest rates. And finally, a strict sell condition is triggered if the bank's capital armor deteriorates or if credit losses suddenly surge out of control.
This quote from the report really hits the nail on the head and serves as their final warning. A bigger bank isn't automatically a better investment. Adding 12 million customers and buying multi-billion-dollar banks in the US and UK creates massive scale, yes. But scale means literally nothing if management destroys long-term value, fails to integrate those new assets, or weakens their financial armor just to fund aggressive shareholder returns.
Which leaves us with this final pivotal question to ponder. As Santander pushes its aggressive engine to the absolute limit, buying up growth and handing billions back to shareholders, will those massive rewards ultimately come at the expense of its necessary financial breaks? It's a delicate balancing act of global proportions, and one that is definitely worth keeping an eye on. Thank you so much for joining me for this explainer, and keep learning.